afternoon and welcome to the Finance 653 project. Welcome to my finance party. My name is Justin Archote and I'm going to take you through my project. So our objectives. We were asked to analyze 15 firms across 3 industries. So that's 5 companies per industry. We were picking the highest performing firm in each industry, and then at the end we picked the highest performing firm overall. So this is a quick snapshot of all my companies. I won't stay here too long because we'll break them down and I'll talk about the companies as we go. So the first industry I'm going to analyze is going to be the hotel and motel industry. It's made up of 5 companies. I looked at Extended Stay America, Marriott Vacations, Hilton Grand, Choice Hotels, and Interval Leisure Group. Just kind of an overview of this industry, some trends that I found. We saw current assets often outweighing current liabilities. We didn't see a whole lot of cash on hand. We saw low borrowing and we saw high EBIT margins, meaning that we had low expenses, which is always good. So descriptions. I won't read this word for word. Choice Hotels International is in the business of hotel franchising under the following brand names. Hilton Grand is engaged in hospitality business and operates vacation ownership resorts. ILG, Interval Leisure Group, offers owners, members, and guests benefits and services, as well as destinations through its portfolio of resorts and clubs. Extended Stay America offers guest rooms, dining services, on-site laundry, local phone calls, etc. Marriott Vacations Worldwide develops, markets, sells, and manages vacation ownership and related products. So first we're going to take a look at short-term solvency. Now, what did I find here? So the current ratio I really liked on Marriott Vacations. I like the current ratio for Hilton Grand. And what we see here is a nice increase over time. Marriott, you see, has the highest numbers. Hilton Grand I like. They start off at 0, but we see them decreasing. Although they do have the highest numbers, they are decreasing. I generally want to see an increase over time. I want to see that my company is growing, getting better, not going the opposite direction. Now, also very important here, we're looking at the quick ratio, because while the current ratio tells me, yes, I have more current assets and current liabilities, my quick ratio says, yes, I have current assets and they're not all inventory. So we see that, you can be fooled by the current ratio because you'll see, oh, this big, beautiful number. We want to make sure that that's not all inventory, because inventory is not very liquid. So I like Marriott Vacations because we don't see a huge difference here between the current ratio and the quick ratio, while some of the other ones we do. And then for cash, not a whole lot of cash on hand for this industry, but I do like Choice Hotels. They have a comfortable cash ratio. Take a look at long-term solvency. I like Extended Stay here and Marriott Vacations. Once again, I see this number decreasing. So for Extended Stay, I see we start at 4.27, we end at 3.03. So we see, not too much borrowing, and the same with Marriott Vacations. Their number is increasing, but it's still relatively low. Then we look at the times interest earn ratio. Can we afford our interests? And as we see here, both Extended Stay and Marriott can definitely afford their interests. Marriott's number is obviously much, much, much higher. Profitability. So once again, and you'll hear this time and time again, I really like Marriott here. So we see a return on equity that we see a really big increase. We start at 6.81, we end up at 23.23 over here. We see a good return on assets, and also we've already highlighted the equity multiplier. So we see little debt. I do like the ROA here for Choice Hotels, but due to the fact that we have no data for ROE and equity multiplier, I simply can't pick that hotel. I can't pick Choice overall. And then ILG, once again, we do like their borrowing, but overall here for profitability, I like Marriott the most. So now we move on to profitability and asset management. I like the profit margin here for Marriott. We also see a total asset turnover. This looks like it's going to be the highest in the industry, and I also see a nice increase. I like that a lot. I won't keep talking about equity multiplier. I do like the profit margin for extended stay and Hilton Grand, and Choice Hotels does have the highest total asset turnover here, but once again, I could not see their borrowing, so in good conscience, I can't choose them. I'm sticking with Marriott Vacations with asset management as well. So we break down ROE, tax burden, interest burden, EBIT margin, and we see that extended stay here, EBIT margin, these numbers look really good. These are high, meaning that their operating expenses are kept low. And so we also see a small increase here. So I really like the EBIT margin on extended stay. I like tax burden, interest burden for Marriott Vacations here. Hilton Grand has a good tax burden. I like this EBIT margin here. Very stable numbers. Overall, though, I like extended stay and Hilton Grand. It's important to note here that, while tax burden and interest burden are great, we want to see those numbers high, so we're paying less in interest and tax. I don't want that carrying the ROE. I'd much rather see EBIT margin high, so we know that the operating expenses are low. Market value. So Marriott Vacation here, price over earnings, PE ratio looks really good. What we think about a company's future relative to its past. The numbers are high and they're also increasing. So while extended stay, they start off high, we see a decrease here. I'd much rather see numbers lower but increasing. So once again, I'm choosing Marriott here. Also like their market to book. Once again, it's increasing and the numbers look good. Continuing with market value. So I like Marriott. They add economic value. They did start out with negative 32 and then negative 22, but we do see a trend upward here, ending at 61.88. But overall, for market value, I do like Choice Hotels because their economic value added is positive over the 5 years we observed them, and they do trend upward. They also have a nice enterprise value, the theoretical takeover price. We'd like to see that number increase. And then their EVA spread looks good as well, meaning they surpass shareholder expectations. That's always good. We really, really, really like that. So as far as market value goes, I do like Choice Hotels. Cash flows. So I like extended stay here. We see a free cash flow. We're starting at 122. We end up at 277. Also nice free cash flow to equity. I do like Marriott Vacations for their free cash flow to equity. I don't like that their number increases here for free cash flow. We start at 140. We end at 115. And then Choice Hotels, overall, if we look at all three cash flows, I do like these numbers. So I see increases across the board with Choice Hotels. So supply chain, couldn't find data on three of the companies, so this really isn't going to make up my mind one way or the other. So, my favorite. I like Marriott here. Marriott was a favorite in short-term solvency, profitability, and market value. It's not always the highest performer in each category, but we do see a trend of improvement over the 5-year analysis in most categories, and that is very important. So the only other company in the running was Choice Hotels, but it had liabilities that far outweighed its assets, and so for that reason I could not pick them. So now we're going to move on to the non-alcoholic beverage industry. So the 5 companies I analyzed for the non-alcoholic beverage industry were J.M. Smucker, Monster Beverage Corporation, Coffee Holding Company, Jam and Java, and Farmer Brothers. As you can see, I kind of tried to stick with the coffee trend here in the non-alcoholic beverage industry. Now, what do we see here trends in the industry? We see low borrowing, which we like. Most companies had a bright outlook on the future in terms of PE and market over book. Half of the companies failed to add value and meet shareholder expectations. I don't like that. So a little description of each company. J.M. Smucker Company manufactures and markets food products on a worldwide basis. You probably know them best for their fruit spread and their Jif peanut butter, but they also acquired Folgers, the coffee giant. Monster Beverage Corporation operates as a holding company. They market and distribute energy drinks. Coffee Holding Company is a wholesale coffee roaster and dealer. The company's primary business is roasting, blending, packaging, and distributing coffee for sale under private labels and their own brands. Jam and Java, they produce their own premium organic coffee from the Blue Mountain region of Jamaica. It's important to note here that they did join another corporation. They signed a joint venture in 2017. For the purpose of this project, we're going to analyze them as if they did not join them. And then Farmer Brothers Corporation operates as a coffee food service company, roast, package, and distribute coffee and other products. So, short-term solvency. Right here, I really like Monster, and you'll hear this time and time again. But we see a very comfortable current ratio. But more important than that, we see a quick ratio that isn't very different from the current ratio, meaning that this current ratio is not made up solely of inventory. And we also see a comfortable amount of cash. So in terms of short-term solvency, I like Monster by far. Long-term solvency. So once again, I do like Monster. We see very little borrowing here. We see a crazy tier ratio, times interest earned ratio. So they obviously can afford their interest. I do like Coffee Holding Company. They also have low borrowing. And then Farmer Brothers also, they have low borrowing and a comfortable times interest earned ratio. I picked Farmer Brothers here because we see a nice comfortable downtrend in borrowing and a huge increase in times interest earned ratio. Profitability. Monster was by far my favorite here. So we see, their borrowing is stable. We see stable return on assets, and then stable return on equity. Now, generally, I don't like to see a decrease in ROA and ROE, but these numbers are so much larger than the rest of the companies that I can forgive that we are seeing the numbers dip a little bit because, like I said, the numbers here, nobody else is really even close. But I did mention that I liked ROE of Smucker, and then the borrowing and ROA of Farmer Brothers. But overall here for profitability, I do like Monster. So profitability and asset management. I really like Monster here. Once again, we like their borrowing. We see a very comfortable profit margin. And I like their total asset turnover. Coffee Holding Company, I really do like their total asset turnover as well. But overall, I like Monster here in terms of profitability and asset management combined. So we break up ROE into tax burden, interest burden, and EBIT margin. I really like Monster's EBIT margin. So they by far had the highest EBIT margin, meaning that they're good at keeping their expenses low. And we see a good increase here, meaning that they're figuring out how to lower their expenses over time. I like that. I like to see improvement, and Monster definitely does it with their EBIT margin, and once again, their profit margin. In terms of market value, so the PE ratio, Monster had really good numbers here, way above everybody else. So we see it starts at 34, we end up at 47 over here, and we also see a very comfortable market to book. If you take a look at these numbers, Monster is way ahead of everybody else. So they're definitely my favorite in terms of market value, and then continuing with more market value. We see economic value added here, huge numbers. So we started at 255, economic value added here in 2017 of 540. Their enterprise value, we end up at 34,491. So nobody else is even close to that. And then EVA spread, we see that they're exceeding expectations year after year after year, and we see stable numbers. Cash flows, I like Smucker and Monster here. So we see stable numbers. Also, we see increases across the board here. Really like free cash flow for Monster and Smucker here. Free cash flow and free cash flow to equity. They're both my picks here. So we take a look at the supply chain. Monster and Smucker were very, very similar. We see 5 suppliers for Monster and 23 customers, 6 suppliers for Smucker and 26 customers. So between those two, I'm kind of indifferent. So my favorite here. So the winner of this industry was definitely Monster. I'm sure you could tell that by how many times I picked them. So Monster's ability to easily meet short and long-term obligations, limit their operating expenses, command a high amount of profitability, and surpass shareholder expectations, and create a bright future in terms of market value, make them the standout company in the non-alcoholic beverage industry. Nobody else is really close here. So my last industry is wealth management. So a little bit about this industry. This industry had some crazy numbers. We saw a lot of volatility. We saw a lot of missing data. But my 5 companies here are Siebert Financial, Charles Schwab, Ladenburg Thalmann, E-Trade, and TD Ameritrade. So what I meant by missing numbers, the wealth management industry reported no current assets or liabilities here. Could not find it anywhere. No current assets, no current liabilities. And I think this was due to the fact that I looked up, what was going on in this industry. And I read that banks, and while these aren't exactly banks, they are investment services, so they do provide service, not many goods. So I looked it up, and banks, they don't produce physical goods. Instead, they borrow and lend funds. So a bank's income comes primarily from the spread between the cost of capital and interest income. So banks do not have fixed assets, and they rely heavily on borrowing as their primary source of capital. So it'd be different if I could not find current assets, current liabilities on one firm in this industry, but none of them had it. So we just assume that this is an industry trend, not poor performance on the end of one company. So we did see a high amount of borrowing, similar to the banks that we just read. These were much higher than the other 2 industries in terms of borrowing. And we saw, once again, interest burden and EBIT margin were not reported. Like I said, a lot of things were not reported in this industry. Firms in this industry did not meet shareholder expectations for the majority of the years observed. So, the EVA spread, and we'll get to that later, they often did not meet shareholder expectations. And they also rarely added economic value. So, a little description of each company. Siebert Financial Corporation operates a retail stock brokerage business as well as corporate investment banking and some other things. Charles Schwab provides a variety of financial services to individual investors, independent investment managers, retirement plans, and institutions. Services include securities, brokerage, banking, and related financial services. Ladenburg Thalmann Financial Services provides independent broker-dealer, asset management, wholesale insurance brokerage, investment, and trust services. Then we have E-Trade. They provide online brokerage and financial services. TD Ameritrade, through its private client, institutional client divisions, provides tiered level of brokerage products and services tailored to meet the varying investing, trading, and execution needs of self-directed individual investors, financial institutions, and corporations. So let's take a look at short-term solvency. There is none. So once again, I could not find any of these numbers, so therefore this cannot be a factor in my decision. Long-term solvency, I had no times interest earned ratio, but I did get to see their borrowing. So strictly looking at equity multiplier here, I like Siebert Financial. They were really the only ones with low borrowing. Everybody else here, you see a lot of borrowing going on. So for that very reason, I'm choosing Siebert Financial in terms of long-term solvency. So moving on to profitability, we talked about equity multiplier. In terms of returns on assets, return on equity, I do like Charles Schwab. They had a nice increase from 0.77 to 1.01 for ROA. And then ROE, we see some stability, and we do see an increase. The same thing with E-Trade. We see some stability. We see increases across the board. But I chose TD Ameritrade here because we see stability and increases. And we chose them just because we see low borrowing here. Low in terms of the industry. So we see good ROA, good ROE. But what really made my decision is Charles Schwab up here. They borrow way too much. This number is 3 times what TD Ameritrade's borrowing. And what do they have to show for it? Their ROA and their ROE is right there or lower than TD Ameritrade. So for that very reason, I really like TD Ameritrade here in terms of profitability. Moving on to profitability and asset management. Siebert Financial, we see negative profit margins for 4 out of the 5 years. Ladenburg Thalmann, once again, we see negative profit margins. We do like Charles Schwab profit margin, but once again, too much borrowing. So E-Trade, we really like their profit margin, and TD Ameritrade, we really like their profit margin. And you know, nothing to rave about here with total asset turnover, but it's positive. And like I said again, we see small, little borrowing here from TD Ameritrade. So for that reason and their profit margin, I'm going to go with TD Ameritrade again here. So we break down ROE into tax burden, interest burden, EBIT margin, and profit margin. Once again, story of this industry, we're missing some numbers. E-Trade, we do like their profit margin. TD Ameritrade, we do like their profit margin. And tax burdens, there really wasn't a whole lot here that make anybody stick out. Siebert Financial, they had the best looking tax burden here, but their profit margins are negative for 4 out of the 5 years. So I'm sticking with TD Ameritrade. So market value. Here I like Charles Schwab. We see a good PE ratio, very, very stable, from 33.33 to 32.52. So we see a lot of stability here. We see a comfortable market to book ratio as well. I do like the market to book ratio in E-Trade, but their PE ratio, we do see a little dip. So we see a decline instead of an increase. TD Ameritrade, I like their PE ratio. We go from 21 to 29, so I do like to see that increase. And then I also like their market to book. We see increases there. So for these two, I did choose Charles Schwab and TD Ameritrade. I'm indifferent between those two. But this helped me make my decision here. So moving on with market value, while we do see a huge enterprise value for Charles Schwab, this was definitely the highest number. The theoretical takeover price in 2017 was over $78,000. So nobody is really close on that. But if you take a look at their economic value added, we see a huge number, negative 1,838 in 2017. So to be honest with you, I really don't like any of these numbers, because if you take a look across the board, in terms of economic value added and economic value added spread, we see really nothing but negatives here. It's kind of the norm to see negatives here. So I really don't like any of these, and if we're just going to minimize the damage here, I'm going with TD Ameritrade again, but I really don't like any of these numbers I see on this board. We take a look at cash flows. Nothing too impressive here. I like Charles Schwab. We do see a lot of decreases here over the 5 years, so we don't see an increase. We do see decreases. Other than their free cash flow to equity, I do like that for Charles Schwab. E-Trade, I like their free cash flow to debt, but we see a decrease with their free cash flow to equity. There's really nobody here that truly stands out to me a whole lot. But if I had to pick one, I guess I'd go with Charles Schwab in terms of cash flow only. Supply chain, once again right here, this was a bit irrelevant. This didn't sway me one way or the other. I could find data on 3, and there's not a whole lot of suppliers in this industry. So the winner was TD Ameritrade here. And I said, while this industry was the most unique in terms of wild numbers, TD Ameritrade was my favorite. They borrowed less than their competition. We saw a bright outlook in terms of PE ratio and market to book ratio. And we also saw stable ROE and an impressive profit margin. Lastly, we did see a strong enterprise value. So the highest performer overall, I took TD Ameritrade out of this. I knew right offhand that they weren't going to be able to compete with Marriott and Monster. So if you see this, I kind of have it color-coded. I took a bunch of the ratios. So we'll start with current ratio. These were very, very close, but overall I did like Marriott. But that was the only thing where I favored Marriott. The rest of these, I do like Monster. So we see a better quick ratio because we see less separation in the current ratio and the quick ratio, meaning that Monster's current ratio is made up more of other current assets, not just inventory. And that's what I like to see. We do see a comfortable cash ratio as well with Monster. We see less borrowing from Monster in terms of equity multiplier. They can definitely afford their interest. Those numbers are very high. We see better asset efficiency. We see higher profit margins with Monster. And then ROA and ROE are way beyond Marriott's. And Marriott had strong numbers, but not compared to Monster. Their EBIT margin, we see much higher numbers. So we know that they can operate. They have lower operating expenses. And then their PE ratio, we see two really high numbers here. I don't think I explained that yet. So in 2014, 2015, you see their PE ratio jumps from 34 to 116, and then 146, and then levels back down to 34 and 47. So even with these lower numbers, if you take out that huge spike, they're still higher than Marriott. But I did look it up, and what I came up with, why those numbers spiked like that, Monster in 2015 sold a ton of treasury stock they had. They had 1.23 billion in 2014. They had 556 million in 2015. And we also saw, it was like a 3-month period where their stock price tripled. It was very brief though, it was only for a few months. It then leveled back down. And I think that's kind of what's going on here in 2014, 2015. You see those crazy high numbers in terms of PE ratio. But then we level back down. But still, these are great numbers. Even whenever the numbers come back down, these are great numbers. Still better than Marriott's. So for that reason, I like their PE ratio. And then what really sold you, just to top it all off, their economic value spread and their enterprise value. So we know the company is worth a ton. This enterprise value, this theoretical takeover price, we see huge numbers there, really, really big numbers. And their EVA spread tells us not only are they meeting shareholder expectations, but they're going way beyond what shareholders expect. And how can you not love that? So for that reason, Monster was my favorite company across all industries. And to be honest with you, it was not even close. Their numbers dwarfed everybody else that I looked at. So I said they use less debt, they have lower expenses while boasting an impressive profit margin and return on assets. Their most impressive feature is how well they exceed shareholder expectations. That's what shareholders want. They want their expectations to be exceeded, and they do that year after year after year. And then their market value is beyond all other companies I observed. So I really, really like Monster. And that's it. I thank you guys for listening to my presentation. I thank you, Dr. Cresson, for an awesome semester. And I'm sad to say this will be the last finance party of the semester. Thanks.